I'm sitting here with my 100-person audience having to say like not financial advice, and I have very little harm I could possibly do reasonably. Meanwhile, the Fed gave advice to the entire free world in the entire market. Like, you guys can trust us, take it to the bank. We're going to do this thing with interest rates. And they did a 50x the other way. Like, they went, it was already tough when they were making a 3 to 4% spread. Now they're making a 0% spread, and they're just hoping to tread water until the loans that are at 4% kind of bleed off over the next 10 years or whatever. So that will have an impact going forward as well, because markets, they may be dumb once or twice, but they're going to learn. And so they are in a way training the market to like, hey, don't trust anything we say. We're putting on our clown wig and our little honky clown nose, and we're just a big joke. Anytime we give guidance going forward, don't believe us. And that is what leads to a lot of the volatility that you see. Yeah, there's all kinds of bank FUD. I really don't think I need to spend a lot of time going over it, because that's pretty straight up what everybody's been covering for the last forever. I want your take on it. So it's a good luck. Okay, well, Silicon Valley Bank is probably where the story begins. Silicon Valley Bank is a bank that was one of the largest in the nation. It was in the top 20. I think it was number 16. And what they did is they lent a lot of money to startups. They made lots of risky loans. So the loans that they made were oftentimes to these tech startups, like crypto startups, stuff like that. Now, what's interesting is the way banking works. Okay, let's talk, because I've seen a lot of FUD on Twitter, and I've worked with banks before, so I actually have I probably understand banks better than 99% of Twitter. So I see a lot of bad takes. Banking is not about like stealing your deposits and lending it out for more. That's what like the crypto bros all love, that kind of take, but that's not how it works. Banking is this delicate balancing act. And what it's balancing is actually three things. It's not about loans and deposits, okay? It's about loans, deposits, and good loans, like quality loans, okay? So you make money by giving out a loan. You give money on deposits, okay? So if you have a savings account, you get paid 2% or 3% or whatever. At the same time, they use the money that you gave them, they lend it out as a loan, and they make 5 or 6%. Okay, so they make a margin of say 3 to 6%, depending on what it is. Now they use that to pay for their bank buildings, their real estate, all their compliance stuff with the government, all the salaries of all the employees. At the end of the day, the actual bank itself is lucky to make 1% return. It's not like this big glorious thing. Now, the reason banking is interesting to the wealthy is because you can maybe make that 1% return no matter how much you invested in the bank. So it's one of the few things where it kind of like, it's this steady Eddie 1% return, no matter what, usually like ROA, return on asset, ROI, return on investment, usually a 1%. No matter whether you put $1 billion into it or 10 billion or what, that's an attractive thing to see, that you can get a return like that and it's guaranteed on your investment. And then on top of that, if your stock price is going up, the thing you invested in, then that's gravy on top. So you're getting the 1% guaranteed. Maybe you get a dividend, and then your stock price is going up. So all that being said, you only get that 1% that most banks typically make if your loans pay back properly. So a lot of loans are like it's hard to get a loan. You go in, you ask for a loan for a new house or a car, and they're like, what kind of money do you make? What is your credit score? And they go through the screening process, and it's not just to be a bunch of douchebags. It's because if they don't make that loan back, like if they don't recover the money that they lend you, then the only way to cover for that loss, that hole, because they have to give that money back to the depositor who originally put the money in, is to come out of their income. So the only way for the bank to actually make good money is if they have very, very low amounts of bad loans. And so that's why they're very meticulous in making sure they only lend to good people. Now, why that matters with SVB and this whole banking blow up and everything is because a lot of the loans that they made were to very risky individuals and very risky companies. And these loans all of a sudden start blowing up. And it's not just like one loan or two loan or three. It's a lot of loans. And most of them are crypto related. Maybe they bought a bunch of Ethereum. Maybe that was what they're like, crypto's the future, forget you dollars, we're gonna have an Ethereum. Well, all of a sudden they can't pay their loan back. There's all sorts of reasons, but the loans themselves are going bad. Not only that, But simultaneous to some of these rumblings of bad things happening, there was a bank run. So people are going in and withdrawing as much deposits that they can potentially get. Not only that, but this bank, along with all other banks, you got to understand, we were in this environment with 0% interest rates for deposits, basically, and loan interest rates of being like 4% or so. So almost their entire portfolio is paying the money that they're earning is at like 4%. Those are 30-year loans that they set up 5 years ago, 3 years ago, 2 years ago, until it wasn't until recent until rates went up. So the new loans are higher percentage, 7%, 8%, whatever. But they have the majority of their portfolio is giving them these very low returns compared to what the market is now. Not only that, but today they're having to pay out CD customers, savings account customers, almost that exact same number, 4 to 5%. So there's this mismatch of like money coming in and expenses going out to depositors, and they're not able to cover it. Now, all of a sudden, any sort of hiccup, any kind of breakup of a loan, a bad situation with the loan, a debt that can't be paid, a repossession of a mortgage, whatever, all those things, it was already tough when they were making a 3 to 4% spread. Now they're making a 0% spread, and they're just hoping to tread water until the loans that are at 4% kind of bleed off over the next 10 years or whatever, and they can get higher rates on their loans. So it is a bad situation for banks. So that is my take on why not only SVB, you see that its stock price plummeting. They're going into receivership. The FDIC did say that they're going to make all depositors whole. This was another headline. They said, oh, anyone with over $250,000 in the bank is not going to be covered because the FDIC insurance limit for a bank is $250,000. That's why people will, they'll structure things in such a way that they'll have multiple accounts. So they'll have like CryptoJack as bank account 1, and then CryptoJack and wife bank account 2. CryptoJack, wife, and kids is 3. CryptoJack with his wife as his, in case he dies, she receives it. That is bank account 4. And they'll split $250 across all these, and people will play these games to make sure they're not anywhere over that $250,000 limit. So it was determined that like 90% of the depositors had more than that limit. And so that was the FUD. That was the fear. That was the headline of like, all this money is just like FTX style up in smoke. It's gone. But that's not what happened, right? The FDIC, which is the government insurance that says they will back the deposits of banks, they stepped in. They go, no. Everyone involved here will get their money back. Now there's been other banks, there's been other kind of situations, other blowups. There's a lot going on. The Fed, which is the government, it's a non-government entity, but it is an entity that sets interest rates for all banking institutions. So the Fed is the group that says, hey, interest rates are going up 0.5% or 1% or whatever. These guys for the last, like in 2020, early 2020 and into kind of late 2020, they said, guys, let us tell you all what's going to happen. We will maybe raise interest rates 1/4 to 0.5% in the next year or two. Don't you worry. Well, what happened? They raised it 4%, 4.5%, whatever it was. They moved it really hard and really fast. Well, why that matters is they're telling the entire free world, banks included, like, hey, we're going to do this thing with rates. And we're giving you guidance. Here's what we're going to do. I'm sitting here with my 100-person audience having to say, like, not financial advice. And I have very little harm I could possibly do reasonably. Meanwhile, the Fed gave advice to the entire free world in the entire market. Like, you guys can trust us, take it to the bank. We're going to do this thing with interest rates. And they did a 50x the other way. Like they went way, way, way more than what they said. Well, all these institutions, banks included, like SVB, they bought bonds, they bought treasury bills. They made a bet on the future, thinking they were not risky bets. These are banks, for God's sake. They're not like YOLO entrepreneurs, like we either feast or famine. They're just trying to be conservative and like, oh, well, if they say this is going to happen, then let's do this as a response, just to be safe. The only thing they could have done is completely called BS and done something completely different and been like, no, they're lying. They're going to do this other. That is the risky decision. There's no world where like a publicly traded bank can make that call. Like, no, you're full of crap, Fed. I'm going to do something. Depositors, don't worry. You know, investors, don't worry. I know what I'm doing. So there's a lot going on, and it is not about like crypto blew up a bank, which is some of the headlines that I've seen. It's not about that. There's layers to the onion here, and a lot of the fault lies with the Fed themselves. These are guys that are not part of the government that are twisting the dials, twisting the screws of our economy, providing guidance of one type, and then forcing the economy to do something completely different. And we've seen the result. So that will have an impact going forward as well, because markets, they may be dumb once or twice, but they're going to learn. And so they are in a way training the market to like, hey, don't trust anything we say. We're putting on our clown wig and our little honky clown nose, and we're just a big joke. Anytime we give guidance going forward, don't believe us. And that is what leads to a lot of the volatility that you see right now in all the markets, in the traditional markets, in the crypto markets, whatever. If you followed the traditional markets at all, you're seeing like mainstream stocks up 10% one day, down 5 the next, up 20 like the week after, down 30 the next week. I mean, it's all over the board because nobody has any confidence, really. This is my take anyway, in what's going on. But that shouldn't matter, because it is our job as technical analysts to try to make sense of the charts, not what the Fed says. So I'm not trying to be perma bulljack, perma bearjack, just charts jack. Just whatever the charts are telling you, that is all I'm good for. That's all I'm here for, and nothing else. I'm not your hype man. You know, I'm not your bear guy telling you to sell.